Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two relatively cheap retail stocks to consider buying as a longer-term investor amid the pretty massive market downturn in the first 4 months of 2022. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these two stocks, which are set to report next week, I want to quickly go over the broader market just to give a better sense of what's going on and what's possibly going on with these two stocks specifically. So if we look back, last Thursday's bounce was pretty short-lived, with the market giving up all of its gains that it saw last Thursday to end what's been what was at this point a rough April on a really low note. So the Nasdaq closed regular trading hours last week 4.2% down on the day. After it jumped 3% Thursday, the S&P 500 dropped 3.6% last Friday, following its 2.5% climb. So as I said, that big bounce back Thursday proved to be a wash, and stocks closed even lower to end April. So the S&P 500 last month was down 8.8%, with the Dow down nearly 5%. Both of those were their worst monthly performances since March of 2020, which was that initial COVID sell-off. Meanwhile, the Nasdaq was down 13% last month, for its worst showing actually since October of 2008, with tech stocks obviously being particularly sensitive to those higher interest rates, so more selling of growth tech names. So at the moment, the Nasdaq is hovering right near its 52-week lows. We saw a little bit of up and down movement so far on Monday morning, back in bear market territory, with the S&P 500 down around 15% from its records as well. Many stocks are now trading beneath their pre-pandemic levels as Wall Street grapples with soaring prices and higher interest rates, and just where the economy is going, how some of these stocks are going to be valued with the higher interest rate environment. And we also are continuing to see clogged up supply chains that are dragging companies and the economy down. And a story that's definitely going to gain more and more attention soon is the ongoing lockdowns in major Chinese cities that have been going on for weeks and weeks now, as they try to get to their COVID zero policy, which you just wonder how long that's going to last, which is definitely going to make matters worse on the supply chain side. And last week we saw all the big companies, Apple, Microsoft, Facebook/Meta, Alphabet, all report earnings. We saw Boeing and other big market movers as well. So these companies are even showing low growth. Amazon had a horrible day last week. It's starting to feel the pressure as its revenue slows. So it's definitely obviously lots of fear going on in the market. The wave of selling has seen, these big players drop 10% in a day. These market movers and heavyweights can really make investors scared, want to stay on the sidelines, which is fairly reasonable. But it's not all doom and gloom, especially if you're a longer term investor. U.S. consumer spending actually climbed in the first quarter. The S&P 500 is set to keep growing in terms of revenue, earnings, and margins in 2022, 2023, and beyond. And if we look in terms of just recalibrated valuations, the S&P 500 is now trading at about 20 times forward 12-month earnings, which is it's on its lows, but it's much lower than it has been. It's trading below its highs trading at about 24 times forward earnings at the height of that initial COVID bounce back, and then it's now not even too far above where it was at some points in late 2017, and its median over the last decade was 17.5 times forward 12-month earnings, and we're sitting at 20. And if you go back to 2012, those were those lows of this last decade, and that's when tech was making up a lot less of the S&P 500. So valuations have been recalibrated. We're still expecting revenue, earnings, and margin growth, and the economy is faring perhaps a little better than you expect. So even with rising interest rates, investors could be looking to stocks in order to outpace that 40-year high inflation, about 8.5% inflation at the moment. So if you're a longer-term investor and you're looking to try to get into some stocks and hold them for maybe the next few years at least, if you're buying stocks with the market down 20%, that's not necessarily a bad idea. Maybe don't go all in on any of these things, because the market could continue to see volatility and more selling in the near term amid all of these fears. But if you're a longer term investor, you might want to consider now is a chance to start taking some smaller positions in stocks you consider holding for a long time. And two of these stocks we're going to look at today that are worth maybe considering as cheaper, maybe not out of the mainstream of retail, that are having the ability to grow over the long haul. We're going to look at two of those stocks today. And the first one is Yeti, which trades in the ticker YETI, so just like the company's name. And they are set to report their Q1 2022 results on Wednesday, May 11th, so next Wednesday. And we're just going to go through Yeti and see why it might be worth taking a bite out of at the moment. So Yeti stock has been hit pretty hard amid supply chain disruptions and higher costs that are now eating away at some of its profits. The company said last quarter that it expects supply chain headwinds to remain in 2022, but its growth is still there, especially on the top line, and it expects to grow in the back half of this year. So let's really get into why investors might want to consider buying the stock by starting at the basics. So Yeti grew its consumer base for its rugged, reliable, simply branded coolers that can cost up to $1,300 by expanding way beyond its massive coolers that were geared towards commercial fishermen and people who really needed to keep anything cold for an extended period of time. I actually was gifted one for Christmas several years ago, and I will say we used it for 4th of July this past year. This is not a sales pitch. I don't own Yeti stock, but I will say it does keep your ice very cold. We had ice in it for about 2 days in the middle of the summer in Chicago, and it was like 90 degrees. And it was actually shocking because I'd never really seen it in action like that. So there's a reason why people pay this much money for them, because they are reliable. And obviously they've gotten cultural cachet as well. So the firm now sells a growing array of styles, sizes, colors. They also sell multi-purpose gearboxes, buckets, outdoor chairs, dog bowls, everything under the sun now. And their biggest category is actually their drinkware business. So this includes mugs, tumblers, jugs, bottles. That unit accounted for 60% of total revenue in 2021, which is pretty steady from what it was in 2020 as well. The company's also ventured into the bag market. It's rolling out more luggage, backpacks, and duffels, and the company definitely has an opportunity to compete against other sort of newer up-end or higher-end brands like Away in the travel bag space. So another growth market for Yeti they're getting into as well. So with all of this, their diversified portfolio helped the company's revenue grow by 20% to $1.1 billion in 2020, with its direct-to-consumer sales up 50% to account for roughly half of sales. This came on top of 17% growth in 2019. And then if we look back to 2021, its revenue then surged 29%, so roughly 30%, to $1.4 billion, with its direct-to-consumer sales up 35%. So its direct-to-consumer channel grew to be 56% of total net sales, with its wholesale revenue up 32% as well. And we also saw its gross profits increase 30% last year, with its adjusted earnings up 37%. So it's good to see the company continuing to grow that direct-to-consumer business. Obviously, its wholesale business still is an important part of the business. They sell their coolers at places like Dick's Sporting Goods, places like that, Walmart, beyond other places that are more outdoor focused. And obviously, along with its own e-commerce channels, the company is slowly building out its own brick and mortar business beyond its flagship store, where it's headquartered in Austin, Texas. And it's been able to slowly expand those efforts. There's a store in Chicago, other places, and it's really thriving among these newer, younger, higher ed brands that includes the likes of Lululemon and others. And the company is really poised to benefit from what remains, as I just mentioned at the top, strong consumer spending despite these rising costs of everything in the economy. And this is highlighted just because the people who are willing to spend, say, $40 on a mug or more than $500 on a cooler aren't necessarily feeling the economic pinch as much as others. So that business can maybe thrive in the long term as it's geared to a higher end consumer as well, higher income consumer. So if we look ahead to 2022, we're calling for another 19% revenue growth all the way up to about 1.7 billion. And then we're calling for another 15% in 2023, all the way up to nearly 2 billion. We're also calling for, despite all the headwinds, calling for another 12% adjusted earnings growth this year, and then another 22% adjusted earnings growth up to $3.50 per share next year. And if we take a look, since the company last reported, when people were seeing lots of downward revisions after the report, the company really didn't fall that far. So its 2022 estimate went from $2.96 per share before its last report to just $2.87 per share. So really not much of a fall off. And then its 2023 EPS estimate went from $3.54 to $3.50. So not much of a downward revision there, which shows that the company's been able to outpace and outmaneuver some of these setbacks that have been hurting other retailers perhaps more. And the company also boasts a pretty solid history of bottom line beats, including a 25% average beat in the last 4 quarters. And Wall Street also remains pretty high on the stock. So 7 of the 11 brokerage recommendations that Zacks has are strong buys, with one more buy and then nothing below a hold. Given though its overall downward earnings revision activity, the company lands a Zacks ranked number 3 hold at the moment. And then in terms of its stock price, this is where people might start to get even a little more excited. So because its stock was falling so bad and big, where it doesn't think it was justifiable in terms of how far its stock has fallen, the company back in late February said they were going to start buying back a ton of stock. So they rolled out a $100 million stock buyback program. The company's CEO at the time said, "We remain confident in driving near and long-term demand for Yeti brand, while also focused on efforts to drive shareholder value. Given the recent market dynamics, we believe our shares are undervalued, and this share buyback provides the ability to take advantage of that current valuation." And that was even when the shares were priced above where they were today. And we should also note that the company has a pretty solid balance sheet at the moment. So that supports obviously the buybacks and just its long-term growth efforts. So now let's get to the price movement I alluded to. So overall, the stock's up about 193% since it went public in the fall of 2018. This compared to its broader leisure and recreational products market that's actually down 11% over this stretch. So that said, that run of 193% includes a roughly 45% decline in the last year, and so far it's down 40% in 2022. That said, the stock has popped. Last time I looked on Monday morning, it was up about 1% the last time I looked, at around $50 a share, which is marking about 50% below its highs of $108 per share. And its current Zacks consensus price target marks about 87% upside to those current levels of Yeti, trading, as I said, at about, let me look this up real fast, trading at about $50 per share at the moment. Yeah, $49.91 as of just now. So with that said, its valuation is even more enticing. Along with that falling stock price, its valuation looks really enticing. So it's now trading at about 16.9. So you call it 17 times forward 12-month earnings, which is way below its median over the last several years. Its median was about 31 times forward 12 months earning. Its high was 45. It's now trading at 17. This also marks a discount even to its broader industry, which is trading at about 19 times forward earnings, which is impressive considering the stock has crushed it over the last 4 years. So for any investors looking to buy a well-valued stock that has a long-term growth outlook, ability to grow both its top and bottom lines at double-digit rates amid the current economic environment and able to fight through all the supply chain setbacks, Yeti seems like it's worth considering. As I said, the market's really volatile at the moment. If you want to wait until after its earnings, maybe you could scoop it up for even less. But if you're a longer-term investor, maybe it's time to start considering taking smaller chunks out of these and maybe dollar cost averaging into the stocks amid this broader downturn. And the next stock up fits in a similar category, though it's more tech focused than its other retail competitor in the new upscale market of totally different pocket as well. So this is Sonos, which trades under the ticker SONO, and it's successfully challenging tech titans and growing its share of the expanding consumer tech space, which is that home speaker market, the high-end home speaker market. The company's also set to release its Q2 results actually of 2022. So it's a little bit off the normal quarterly results schedule, but it's set to release its results Wednesday, May 11th as well, the same date as Yeti. So let's go into the company as a whole, and then we'll see what's happened more recently. So Sonos first shipped its its first product to consumers back in 2005, and it kind of helped usher in the modern high-end speaker age. Today, it competes in a pretty crowded space alongside the likes of Bose and other home audio firms. That also has seen the big tech powers like Apple and Google jump into the space, and it's been able to grow its market share even against those big giants. Sonos specializes in the wireless and multi-room sound system, and it aims to attract really everyone from music lovers to movie lovers, and just anyone who wants kind of a higher end, sleek feel at their home in terms of speakers. And they're so much smaller than if you have old speakers from say 10, 20 years ago and all these cords. They've been benefiting a lot just how easy and seamless and small these speakers are for how big the sound can be. So the company doesn't attempt to be in that direct like voice assistant speaker market, which helps to kind of differentiate itself from those Google Assistant speakers and Amazon Alexa. It's attracting consumers who want that big, high quality sound. So it sells a range of connected speakers, subwoofers, sound bars, normally in black or white. The company also has officially entered the portable smart speaker market. So ones that don't plug in, you can take with you. Its mass market speaker is called the Roam. It's now its cheapest speaker. It's about $180. They now have an even lower cost one that's the Roam SL. It's about $160. And they also, even at a higher end, they sell speakers that are architectural speakers that can be built into the walls and ceilings depending on your various offerings. So they really have everything that's from baseline speakers for $160 you can take with you to the beach or wherever you're going. Great sound quality, to packages that cost over $2,000 if you want a higher end home theater experience at your house. The company, along with speakers, has its ad-free radio like streaming service that goes along with its devices. You can pay $7.99 a month for that. It also has a ad-supported tier as well. So that's its outside business of beyond its direct core speaker business. So now let's look at what they did in 2021 and then what they did in that most recent first quarter of 2022. So it posted pretty impressive results in fiscal 2021, which was the period ended on last October. And its full year revenue was up 30% to $1.7 billion, and its adjusted earnings skyrocketed from 67 cents to $1.77. So really strong results. It also crushed our Q4 estimates at the time, and its gross margin climbed as well, and its free cash flow also improved. As we touched on earlier, Sonos has amassed a really growing and loyal customer base. So last year, its households were up 15% to about 13 million. And the company also said, its CEO said that they consistently see existing customers adding more products, which is great. So that shows how good their speakers are, that people are adding onto it. And that's kind of their platform, is that they can all connect to each other. You can buy one at a time, you can buy packages. So if you like one, you can buy another one for a different room, and they can all sync together. You can play music throughout your whole house. So the company said that last year, so 2021, it ended where total products per household it had increased to 3 total, and they continue to see repeat buyers helping to drive the business forward, as well as they add more new customers as well. So the first quarter of 2022, it did cool down. Revenue was up 3% year over year. Gross margin increased 140 basis points to about 48%. But obviously, they're facing near-term headwinds and setbacks just that are hard to get around, supply chains. The firm's pretty confident, though, in their longer-term outlook. So we're going to get to that in a second. So they're coming off their best year since they went public in 2018, 30% revenue growth last year, driven by increased home-focused spending. This was on top of 5% top-line expansion in 2020, 11% in 2019, and if we look ahead, we're calling for another 15% top line growth this year, and then another 12% in 2023. So consistent double-digit growth in the next 2 years, all the way up to $2.2 billion. We are calling for a setback on the bottom line. We're calling for its adjusted full year earnings to slip 30% year over year. This was after a big growth year last year, but then bouncing back next year in 2023. But also in terms of Their overall consensus estimates, they've not gone down too far compared to what lots of companies have seen. So similar to Yeti, the magnitude of those revisions, they went from $1.29 per share for the year consensus estimates to $1.23 per share. And then for 2023, we were at $1.55, and now we're at $1.51. So not these massive downturns as some other companies are dealing with. As I said, maybe if you're thinking about either Sonos or Yeti, you could wait for updated guidance because this is a lot's changed in the last several months. But so far, those are the most recent revisions we have. And then we should also note the company's been able to really surprise to the high end. They beat by 16% last quarter, and they were able to blow away our results in the 3 quarters before that. We were calling for an adjusted loss, and then all in the 3 quarters before that, and all 3 times they came out with positive earnings. So they've been able to do really well in the bottom line in terms of beats. And then if we're looking overall, as I mentioned, their 2024 targets they've provided, and they're consistently saying they're going to be able to make these targets. So they're calling for revenue in 2024 of approximately $2.5 billion, which would represent a compound annual growth rate of about 13%. And then this revenue target, they said, is at the head of what the company originally said they were going to try to do for 2024 when they first rolled out this guidance in March of 2021. So they originally said they would be at $2.25 billion by the end of fiscal 2024, and now they're calling for $2.5 billion. So $250 million more they're expected to make over that time. And then its gross margin, they're expecting in the range of 45 to 47%, which is consistent with that range they reported back in March of 2021 before there was all these setbacks in the economy in terms of supply chains. So overall, continuing to see strong growth. And the company's CEO said the opportunity is tremendous. They're just continuing to add more and more customers. Repeat customers continue to be huge. And they also, once again, they only have a small market share of what they say is a $90 billion global home audio market. So they only have 2% of that market share at the moment. And they said that their brand is continuing to gain momentum. So they really believe that they're able to capture more and more of this market. And even if they get up to, say, 5%, that's just a lot more money as this market continues to grow. So Sonos, also like Yeti, lands a Zacks rank of 3 hold. It has a B grade for value and an A grade for growth. The company also boasts a really strong balance sheet, which is good to know as well, especially when you're trying to buy companies amid a market downturn. You want to know that they're operating a solid business with strong financial backbone. So the company has $754 million in cash and equivalents, about $1.2 billion in current assets, $1.4 billion in total, against just about $693 million in total liabilities with 0 long-term debt. So solid balance sheet as well. So then in terms of the stock price, Sonos is up 103% over the last 3 years compared to the broader home audio video market's 50% climb. So big outperformance there. But then, like many stocks, it's now down about 43% over the last year, which is far worse than its broader market. So the stock is currently trading at around $23 per share, which is 45% below its records, and its current Zacks consensus price target marks about 85% upside to its levels at the moment. And then in terms of its valuation, the stock's now trading at about 16.4 times forward 12-month earnings, which is 65% below its highs over just the last year and well below its median. So its valuations come down in a big way, and both Yeti and Sonos might be longer term plays to consider. And for all the things I've said before, excuse me, maybe don't jump into these stocks if you're trying to get in and out of them around earnings, just because there's been such major moves with even much larger companies. So these smaller companies with lower share prices are prone to maybe move even more. But if you're a longer term investor, they're both certainly look worth considering as taking at least a little nibble out of at the moment amid their fall in prices, their valuations and then their longer term outlook, especially even in the next couple of years, able to grow amid all of the current economic setbacks. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.